Show.
Personal Finance with Warren Ingram.
Warren back from his holidays, because he has lots of those, because he's very good at planning these things. So last year, Warren has given us so many great examples of why you need to shut down your social media platforms and apply your mind to investments and stop watching what anyone else is doing and simply think for yourself. Is that a fair sort of assessment, I think, of what we've learned over the past year or so?
I think it's what we were shown, and I think it's a very fair assessment, Bruce. I'm not sure it's what we've learned.
Okay.
And I think if we watch, we watch investor behavior time and time again, over decades now, we see the same thing repeating itself. What's different this time, and you point out the social media accounts, is that everything happens a lot quicker. So the kind of the excitement and the hype builds much faster. The information spreads much further, and more and more people are caught and dare I say suckered into putting money into things that they don't understand, and end up losing huge amounts of money all around the world. And so my question to myself when I'm watching this is, are we really learning anything? Have we not seen this movie before over and over and over again? And it's just the title that's changing, and it's instead of taking 2 hours, it's taking 30 minutes. But surely this is human behavior just repeating itself, and maybe new generations of investors getting caught.
Give me some examples of what happened last year. I think you got a couple in terms of there were some winners, absolutely, and some of the big trends, but there were also some very, very big losers.
Yeah, so the ones that really caught my eye were two. One was a share called GameStop, listed in the US. It is an American business. Frankly, has no reason to exist anymore. It's a business that sort of sells computer games in physical form. And nowadays people buy them online, and in fact they stream them. So it's a business that's dying, and it became a social media favorite. Especially on Reddit, and in a period of 19 days, if you'd put $1,000 into GameStop, your $1,000 became $20,000. And that's 19 days. And in that time, the hype was just phenomenal. It just caught on, and anybody that cautioned against investing in GameStop, especially the talking heads out there that were saying, look, this is just not a business that should be around anymore, were kind of written off, or in fact lambasted for being part of Wall Street or being part of the vested interests, and it was some kind of a establishment move. And what's interesting is, you watch GameStop from its peak, and as I said, that it was 19 days, and it was right at the start of January. From someone who put $1,000 into GameStop at the peak would now be, at the end of the year, be sitting on $405. And that just shows you it wasn't, it's not a business. It doesn't deserve to be around. And unfortunately, there weren't many people that would have been clever enough to anticipate that an arbitrary company becomes a social media favorite, absolutely explodes in a period of 19 days, put all their money in before the time, and then sell on the peak, 19 days later. It wouldn't have happened. So actually what happens is that the bulk of the money went in at the peak. It went in, after the bubble was about to burst, and when it did burst, lots of people lost a lot of money. Very sad story.
Traditionally, those are called sort of pump and dump schemes, where if you watched The Wolf of Wall Street, you would have these guys sitting in what they call boiler rooms. They'd be phoning up their clients and they'd be telling them to buy things and pushing up prices artificially that way. And then you'd have big owners of the shares capitalizing on the hype and selling into the hype. And I wondered just how much of that was to do with GameStop.
So as you mentioned at the start, I've had some time off, and I've done quite a bit of reading about this. And actually, there were some quite big investigations into GameStop, and to understand whether there was manipulation. Were there holders of the shares, especially institutions, the establishment that everyone hates so much, that were portraying the behavior that we see in these schemes. And the reality is that this started completely randomly by a few people, and not one of them share experts, not one of them with a long history in stock markets, and they they got their popularity on Reddit and with a social media platform not so big in South Africa, and they started talking about it. It created a kind of a little mini tidal wave of popularity. And then the mainstream media caught on to this thing that was suddenly happening and got, wrote about it and spoke about it. And so it became a self-fulfilling prophecy. And then when it exploded, the same thing happened again. It was just a case of collectively people, I think, getting to their point of sanity and realizing, they were caught up in something.
So how do we avoid it this year, Warren, quite briefly?
My view is, if you're not an expert in the current wave of investments, and it seems, and I'm saying investments advisedly, but we're seeing now these NFTs, non-fungible tokens, coming out, and new forms of investments. And if you're not an expert, you don't understand the dynamic, then don't try and play someone else's investment game in a space that you just don't understand. The reality is, if you want to make money, being simple in your investment strategy, and I'm not saying simple in a bad way, but as a compliment, it can make you a huge amount of
uncomplicated. Uncomplicated.
Simple, clear, uncomplicated. And just look at the indexes last year. The American index. The S&P 500, if you put $1,000 in, by the end of the year, you had $1,269. A great return for doing no work, no real permanent loss of capital risk. And in the JSE in South Africa, I did a sort of a similar sum. If you'd started the year with 10,000 Rand, you ended the year with 12,940. And that's not playing anyone else's game. No, that's just saying, I know enough to know that I'm not a share expert. I can't pick the best investments. I don't want to time the markets. I'm just going to put my money away into something that's very broad, very diversified, and I'm going to leave it there and see what happens. And to me, if you're not an investment expert, what a way to make money. You don't need to play other people's games. You don't need to pay huge amounts of costs. Just be simple, stay disciplined, ignore the hype, especially this FOMO. When you see things blowing up in share prices, just, doubling and trebling, just understand that doesn't carry on forever. It does fall over. And then it falls over when most people have just started to really invest for the first time in the price, and they get caught, like we saw with GameStop. So just stay out of the hype. And as you say, stay off social media when you're looking for investment advice. That's not the place to do it. Read books and listen to the show. There's so many brilliant people that are on here every single day of the week where you'll get the advice that you need.
Warren Ingram from Galileo Capital. In a moment, a question from Peter. He's been doing some reading and some thinking, and he's been making some investment decisions and says he wants to make his investments more environmentally friendly. Is it a good idea to sell his existing investments and invest in ESG type funds? Good question, Peter. That with Warren in a bit.
The Money Show.
Personal Finance with Warren Ingram.
Peter wants to become more environmentally friendly in his investing, and he's looking at ESG type funds and wonders whether he should be selling his existing investments and putting everything into ESG type funds. Before we talk about the do's and don'ts here, Warren, what are ESG type funds?
ESG is becoming a very big movement, I guess, around the world and in South Africa, and it stands for environmental, social, and governance. So it's three separate aspects of the way that money is being invested, and actually more specifically the way companies are being run. And then if those companies are being run in a particular way, as I say, around the environmental, social, governance principles, then funds either choose to invest in them or are obliged to invest in them. And if companies are not, running themselves according to the ESG principles, then there might be funds and pension funds and unit trusts and the like that might be forced not to invest in them. So the whole thing about ESG is it's three very distinct areas of the world. The one, environmental, which is really Peter's question, is one aspect, and so I guess we don't need to argue about climate change. It's here. It's a reality. It's a huge threat to all of us. But the other two, social and governance, we've lived through 10 years or 11 years of really horrific governance in South Africa. Again, I don't think we're pretty sensitized to it in South Africa, the impact of bad governance. And then the social is much broader, and it's around making sure that employees are well taken care of, that supply chains are run ethically, where you don't have, for example, child labor, in a country supplying a completely removed market somewhere else. There's a huge aspect to this, this whole theme. And I think the important thing here is it's not just a bunch of sort of long-haired hippies that just sitting around making themselves feel better about their money. It's actually investors saying that if you choose companies that run in according to these principles, that you are making sensible long-term investment decisions, because you're investing with management teams that that have a multi-decade approach and a philosophy of growing themselves sustainably. And so it's a massive theme.
Here's the problem. Yes, it's a massive theme, but there's also a very wide universe, because I'm not too sure that we've got the notion of exactly what E, exactly what S, and exactly what G is, because there are no universal benchmarks. There are no universal rules that we can draw on here. Often the company says, well, we're very good at this ESG thing. We have E, we've got S, and we've got G. Stamp, stamp, stamp. We're an ESG company. And then, a bit like using just desktop analysis when you are a global fund manager looking at ratings agencies, for example. Investors look at ESG and say, look, they say they've got an ESG accredited business, so let's invest there. And I'm not too sure that it's necessarily sharp enough yet.
Exactly, and I think that now you come to the crux of Peter's question as well, because it's one thing to see the theme. And all of us, I think, to a lesser or greater extent, feel aligned to this. But as you say, committing real money to businesses that really, are walking the walk and not just walking the talk. I feel that the answer in South Africa is I'm not comfortable to allocate money to companies that that kind of profess to be highly ranked in the ESG space. It might be that they have ticked all the tick boxes that need to be ticked. But I mean, some of these ratings that I've seen, there are companies in South Africa that are massive polluters, in the top, 2 or 3 polluters in South Africa that carry a very high ESG rating simply because they've done a bit of the work on the S and the G. And for me, if you're destroying the environment, but paying people while you poison them, I don't know. I find, to me, it's still hugely compromised. And I think globally, there are lots of rating agencies that are popping up all over the place that are professing to do the work to provide, an ESG rating, and some are, and some aren't. And so I think it is a developing space, and I think it will get somewhere. But for me at the moment, what it feels like is a time where a lot of active managers have been beaten by index investors around the world, and they're looking for new ways to differentiate themselves. And so ESG has been a godsend for them, because this is the drum that they're beating. And on the other side of this is a lot of the big pension funds and especially the unit trust companies have outsourced an enormous amount of their kind of checking to ratings agencies or proxy companies that that are I think not doing any real work. They are the very definition of tick box businesses. So to me, if a unit trust company says to me, no, we know our funds are highly ESG rated because we use a proxy company running out of London, I'm going to give zero credibility to that. So,
all right. So what does Peter do?
My view, Peter, is invest your money and then take a portion of the profits every year, allocate it to an environmental organization that is doing real work, and use some of those profits to fund that organization and make a real difference with your money, rather than making rating agencies rich. And in time, there will be good ESG options in South Africa. I just think that we're a bit premature at the moment. There are some better ones overseas, but you're going to have to do an enormous amount of homework to find them.
Okay, I think that's a really interesting piece of advice there, Warren, in terms of sort of balancing your guilt, if you like. Because Peter strikes me as somebody who, in a very brief email, really does want to do good and doesn't want to be part of a system that is continually destroying the planet. But if you can't trust the classifications, not yet anyway, to a degree, then you're actually perhaps making some fairly dreadful investments. So you won't get the returns, and you're not really having an impact on the environment anyway. So you may as well make great returns and then use those returns. Pick a number, and whatever percentage of your returns you want to give away, donate it. Give it away as a charitable donation. And that way, that money can be properly used by an organization that you can assess effectively that does make a difference.
Absolutely. And I also think, don't be exclusionary in your investments. In other words, a company that's, let's just say a fossil fuel company at the moment, we would know, fossil fuels are bad for the environment. But if that company is allocating a huge proportion of its turnover every year to becoming a renewable energy business, is it really sensible to to take all the money away from them and stop them making a very positive impact for the next 2 or 5 decades, where they need this time to transition? I think it's this is a really nuanced area, and be very careful of just being completely exclusionary, sort of using the cancel culture with investments. You could be doing more harm than good.
Thank you, Warren Ingram from Galileo Capital. In a moment, what is the S&P 500? I think I know what it is. You possibly think you know what it is. Warren Ingram does know what it is and will share with us in a moment.
The Money Show.
Personal Finance with Warren Ingram.
Lots of indices in the world. One of the most followed, one of the most revered, one of the indices that if you are an index investor, you should be exposed to any day of the week, any year of the decade and of the millennium is the S&P 500. But what is it exactly, Warren?
So the S&P 500 consists of 500 of the largest companies listed on American stock exchanges. And the interesting thing about it is that they're not specific to one stock exchange. In other words, it's not just on the Dow or on the NASDAQ index. It's all of the biggest companies in the US. The only kind of nuance there is that it's the way that they measure the size of those is by the market capitalization. In other words, the size of the number of shares that are able to be traded on a stock exchange. So it's not measured on turnover or profit or something like that. It's simply the value of all of the shares that people can buy and sell on a given day. So it does represent some of the very biggest businesses as well, but it's certainly the best indicator, I think, of the health or otherwise of the American stock market on a given day. It's S&P is a index provider in America, and they are the company that measure this and then put the index together.
A lot of people sort of think American markets are the Dow Jones Industrial Average, but that's only a mix of 30 different companies, and they've got a weird way of putting companies into that as well. It's not like the top 40 of the JSE, which is the top 40 most valuable companies, which is much easier to understand. The S&P 500 is actually a far more diversified and interesting and textured and nuanced and possibly representative index than the Dow is.
Absolutely, and so well diversified as well. At the moment, the technology companies will be carrying a bigger weighting of the index than they did, let's say, a decade ago.
What is Apple's weighting? One company in the S&P 500. So there are 500 companies. What is Apple's weighting in the S&P 500 today?
Are you asking because you know?
I'm asking because I know and I'm feeling smug.
Okay. Well, then I'm just going to let you be smug and tell us.
It's a $3 trillion company. It went from 1 to 2 to 3 trillion over the holidays while we were all having a nice time. It makes up 6.5% of the S&P 500. I don't know what the percentages of all of the top tech companies, but I'm guessing it must be north of 30 or 40%, the huge weighting of these top 10 tech companies in the United States. So it's absolutely enormous. Does that scare you off the S&P 500 in 30 seconds before I let you go, Warren?
No. I think just again, diversification is important. So yes, the S&P 500 is a good index, but it shouldn't be your only global investment. So if it's 40 to 60% of your global investments, absolutely fine. If it's your only global investment, then it is a little scary, and you need to add some, in Europe, UK, Japan, China, other emerging markets as well, to get a proper global spread. In other words, the world index is probably a better bet, but if you want to put the pieces of the puzzle together, S&P 500 is one very good and very important piece.
Warren Ingram from Galileo Capital, thank you very much indeed, Warren. Warren is an executive director at Galileo Capital. He is also a personal financial advisor.